Welcome everyone to financial statement analysis and reporting video. So we will be talking about the financial reporting and financial statement. So what exactly is the differences? Remember, reporting is all about providing information, in this case financial, about the entity to enable users to arrive to a certain decision. Whereas financial informations will include and should include all financial statement and other types of report per se. Now this is all about reporting. Now, what are the statement analysis? Is the decision that you arrive based on the reporting. So analysis is using the financial information, what I said, to assess prior performances and likely future performances to come to a decision. Typical decisions is all about capital allocation. Now I'm just giving you certain formats. In this video I'll give you a plentiful of formats about what financial reporting is all about. It look out here, it is all about the Apple second quarter. This is a way back published report that I'm going to do it. It is in the knowledge of the public domain. So there is nothing wrong around here. We will be looking at the recording of March quarter sales. Net profit been increased of almost 100% year over year. What I'm talking is the second quarter's 2012 report. It is all about the statement that has been done. It is the reporting that what kind of profit it has made, what kind of earnings per share it has been doing it around it, what are the projections, what are the gross margin, and probably what will be the sales and which all sales are coming from which all directions. In this case, which all countries, should I say continent? Preferably, that is what we are talking about it. Now, that was the reporting, financial reporting. This is the analysis. Now, based on this Apple's report, the AAPL report result, what that was astonishing everybody's expectation, so what kind of revenues that they were talking about it, what kind of magnitude of decision that they want to come around it, and this is what Apple saw growth due to strong sales, strong demand, if I may say so. And that is why EPS grew by over 92%. Whooping EPS is earning per share. And this is the financial analysis, and I'm giving you just the example. Remember, financial statements, a statement of financial position, statement of comprehensive income, statement of changes in equity, statement of cash flow as on when on basis. And that is what we are trying to go address out here. Financial statement, the statement of financial position. What are we looking into it? We are talking about assets. What are my assets? All the liabilities that we have plus the owner's equity. So that is my asset. All the liabilities that I have plus my equity, right? So what will be my equity is all my assets minus the liability, as simple as it. And point in time, if we can give it to you. Now, this is what another elaborated examples of the balance sheet. If you look into it, we have the assets and we have the liabilities column. This is the asset column, which states what all expenses that we have come across. It. This is my liabilities, and there comes the total assets and the total liabilities. If you go around it, it is the incomes or is the profit that the company has been making around here. Similarly, for the assets of a Linded Sprungly Group. Now, what am I trying to give it to you now? This is another statement in a reporting format as in December 31st, 2011, and what was done in previous year as in December 31st to 2010. Now, this is what we look into it. Liabilities and equity of Linded Sprungly Group. Again, the simple valuations of fact, what has been presented out here. Now we'll talk about the comprehensive statement of income, also known as income statement, statement of earning, profit and loss statement, as you want to go around it, of from which country you are viewing it and what are the nomenclature being used out there. Comprehensive income, all items that affects the owner's equity but are not the result of transaction with the shareholders. Comprehensive income is net income plus other comprehensive income. Anything that is net income is the income from the business. Another comprehensive maybe some outstanding which was lying down, which came down out here, some bad debt which was recovered, some rental income, some interest income. So presentation permitted a single statement of comprehensive income or two consecutive statements. Remember, net income is the gross income minus the expenses, and you need to mention the period of time as the case might be. Again, the period of time 2011, 2010, 2009. What was my sales? Approximately, if you look into it, it has been increasing over a period of time. it is approximately 6 million. This was 5.5 million. This is 5.25 million, so somewhat 5.3 million perhaps. And the net income similarly. So that shows that the company is growing. That shows the company is progressing. Something about similar statement of another company wherein we are talking about the incomes and the expenses, and less income minus expenses would be your net income per se. Requesting all my audiences, all the participants of this video, please pause it. If you require, you please pause it. I have to adhere to the policies, and that is the reason why I'm going through this, shifting to the next screen perhaps. But if you require, pause it, watch it clearly. Something which I have been seeing around it now is an example, elaborated example of the comprehensive income. Let me look into the changes in equity, as in the ownerships, also known as the statement of change in owners equity. If there is a change in equity from my end, it get transferred to your name, your end, right? So if there is a change in ownership, the statement of the shareholder period of time, beginning equity, changes in equity is all about ending equity. Basic component of owner's equity are paid in capital and retained earnings. Beginning common stock plus issuances additional minus the repurchases. Remember, first the common stock plus any additional issuances minus the repurchases is your ending common stock. Beginner's retaining earning plus the net income minus the dividend is the ending retained earnings. This is what we are talking around here. Again, an example for you to understand. Probably we should be going through it slowly, but I am requesting all the audiences to pause the video and look into it. These are nothing but telling you about the statement of changes in equity as far as the shares which has been issued, which was in the treasury stock with the premium, with hedge accounting, with retained earning and currency translations, and so on and so forth. Talking about the statement of cash flow. I am repeating cash flow. It's again the mention to be period of time, which quarter, which year, which month, if you're looking into it. The beginning cash flow plus the changes in cash. Changes in cash means cash might grow or might shrink. It is all about equal to ending cashes. Changes in the cash from operating account, from investing account, from financing account, as the case might be. Again, an elaborated example for you to understand as to what we want to stress upon here. This is exactly what the changes as for the cash flow is concerned. Look what we are looking into: cash flow provided by financing activity, by investing activities, and how they are churning out. Accompanying notes, other notes are also known as footnotes, as in what happened, who approved certain changes, who approved the expenses. Accompanying the full financial statement are required to form an integral part of the statement. Notes include information on significant accounting choices, as in policies, methods, and estimate. Explanatory details about line items on the face of financial statement. Other disclosure, such as commitments and contingencies. Based on the notes disclosure, analysts can understand whether accounting choices are similar for the companies being compared. If the policy differs, analysts can often make an adjustment so that the financial statement data are much more comparable by way. Let me give you an example of disclosures. Look what we are talking about: property, plant, and equipment. Property, plant, equipment are valued at historical cost, less the accumulated depreciation. The assets are depreciated using a straight line method over a period of their expected useful life, economic life, if I may say so. Historical cost includes all costs associated with the acquisition. Subsequent cost increasing the value of the assets are, depending on the cases, either recorded in the book value of the asset or as a separate asset, to an extent that it can be assumed that it is likely that the group will benefit from it in future due courses of time. Land is not depreciated. Depreciations in other assets is calculated using a straight line method down to the cost to the residual value. The following useful things can be applied: buildings usually 5 to 10 years time, 40 years times. Machineries are 10 to 15 years time. Other fixed assets is from 3 to 5 years time. Profit and loss from the disposal are recorded in the income statement. And this, I'm just giving you an excerpt altogether. The example of disclosures. Look what we are the example. Again, you need to pause it out. Remember about land, building, machineries, other fixed asset, and how it has been documented, as in the addition, retirement, transfer, currency translation, and so on and so forth. So, example of disclosures in notes, as in plant, property, and equipment. What was there in 2010 was 9.4, and right now it is probably double to 24.7 as such. So management commentary, it is a narrative report that provides the context with which we need to interpret the financial data. Remember, the financial position can be interpreted in the form of the economic reality of the environment, competition thereby, financial performance and cash flow of an entity, provides explanation of the amounts in the financial statement, provides information on company's prospects, provides management with an opportunity to explain its objectives and its strategies for achieving those objectives, encompassing reporting that jurisdictions may describe as management discussions and analysis, operating and financial review, or management report thereby. So what are we looking into it? The contents of the management commentary. The IFRS practice statement is a management commentary, states that the management commentary should include information that is essential for the understanding of the nature of business, the management objective, and the strategies to meet those objectives. The entity must most significant resources, as in risk, as in relationship, the results of an operations and the prospects, the critical performance measures and the indicator that the management use to evaluate the entity's performances against the stated objective thereby. In US, the SEC, the Securities Consortium, requires listed companies to provide the MDA altogether every now and then, the management commentary, management disclosures and acquisitions as and when on basis to specify the content. The management must highlight any favorable trends, identify significant event uncertainties that might affect the company's liquidity, perhaps positions or the operations, and so on and so forth. So example of MD&A, explanation of amounts of a financial statement. You see what we are talking about, net sales vis-a-vis 2011 and 2010. I again am giving it an excerpt from Hershey's MD&A annual reports. This is what we are looking into, why the net sale was increasing and for how much, by how much. The question is not by how much, what was the potential and why so much. So you need to ratify whether you have done good or you have relatively done good but positively done bad on a whole scenario per se. So you need to understand the sales volume has increased. You need to understand what has been the revenue factor. You need to understand what is your gross margin. Has it improved or not? You should always talk about the earning per shares perhaps. So example of MDA information, company prospects, as in the outlook. What you are perceiving that is going to happen in due course of time. The outlook section contains a number of forward-looking statements, all of which are based on current expectation. Actual result may differ materially. In excluding the Brookside acquisition, we expect volume to be slight up for the full year 2012, resulting in net sales growth of about 5 to 7%, including the impact of foreign currency exchange rates. We expect reported gross margin to increase approximately 90 basis points in 2012. We expect a full year adjustment EPS dividend, including the adjustment for non-service related pension expenses, to increase over 9 to 11%. Cash flow from investing activity, we anticipate total. Now, what I'm trying to tell, I'm just giving an example for MD&A. Auditor's report will actually tell you what the financial statement has been presented by the companies. Annual report and generally requires to be audited or examined by an independent accounting firm in according to the specific auditing standard. An audit report is a written opinion of the financial statement prepared by an independent auditor. Objective of an independent auditor in conducting an audit to obtain reasonable assurances about whether the financial statement as a whole are free from material misstatement, whether due to fraud or error, enabling the auditor to opine on the whether statements are prepared in accordance to the applicable financial reporting framework, to report on to the financial statement thereby. Types of auditors: unqualified audit opinion, clean opinion, states that the financial statement give a true and a fair view internationally or a fairly presented or internationally and the US in accordance to the applicable accounting standard. IFRS, International Financial Reporting Standard, is the standard that the whole world is supposed to follow or is following right now. So other types of opinion are qualified audit opinion, one in which there is some scope of limitation or exceptions to the accounting standards. Exceptions have been described in an audit report with an additional explanatory paragraph so that the analyst can determine the importance of exceptions. Adverse audit opinion issued when auditor determines that the financial statement materially departs from the accounting standards and are not fairly presented. Generally, an analyst would not bother analyzing these statements. Disclaimer of opinion issued when the auditors are unable to issue an opinion due to some reasons, such as the scope limitation, perhaps. ICS, internal control system of the company's internal system that is designed, among other things, to ensure that the company process for generating financial reports is solid, on a solid footing. Some countries, example US, requires an additional audit opinion in the company's internal control system. Information includes what? Besides the annual financial statement, annual report or a proxy statement, management compensation, perhaps the governance information, interim report, unaudited financial statement with an updated information on the company's performances and the financial position since the last annual period, press release, particularly earnings and announcement and conference call, presentation to analysis, external data sources for information on the economy, on the industry, on the company, and definitely yes, the regulatory context wherever applicable. Direct experiences of companies, product and services thereby. So steps, allow me to give you the steps as in phase. In phase one is to articulate the purpose or the context of the analysis, thereby collect the data. Third would be processing the data, whatever you've collected. Fourth is analyzing the data and probably coming to some kind of knowledge or information from there and develop. The fifth will be develop and communicate the conclusions and recommendation. And probably the sixth is an everlasting follow-up, going feedback as on when on basis. So allow me to give you all the 6 steps. Articulate the purpose and the context of analysis. Purpose of analysis is evaluate the historical performance of the company, trend and cross-sectional. Prepare a forecast of future performances, value company's equity or debt securities. Prepare rating or recommendation. Define the context, intended audiences, end product, time frame, resource and resource constraint based on the purpose and the context. Formulate the questions to be answered as on when on basis. Then we have something to do with collecting of data or analyzing the data or processing the data is what we are looking into here. Using financial tools to process data, ratios as and when on basis. We talk about the common financial statement, analyze data, use financial ratios to assess a company's profitability, liquidity, leverage, and efficiency relative to their own past. I'm talking about the trend analysis as such. You need to understand and get a proper feedback, or should I say, if not a feedback, can we have a peers or a benchmark companies synthesize all available informations to develop an expectation about the company's likely future and performances, develop forecast and use as an input to valuation thereby. What are we looking? Now is a step of communicating whatever you have come to your conclusion or perhaps your recommendation. Communicate the conclusion or recommendation in an appropriate format. Appropriate format will vary the analytical tasks by institution or by audiences. An equity analyst report would typically include the following components, if I may say so: summary and investment conclusions, earning projections, valuation, business summary, risk, industry and competitive analysis, historical performances, and forecast thereby. We talk about a follow-up. The last 6 steps was the follow-up. If an equity investment is made or a credit rating is to be assigned, periodic review has to be required to determine whether the original conclusions and recommendations are still valid. Follow-up may involve repeating all the previous steps in the process of periodic biases. Allow me to summarize what we have covered and what you need to always keep in your mind. As in the financial statement, it should include the statement of financial position, the balance sheet, statement of comprehensive income, PL account, profit and loss statement, statement of changes in equity, the ownership, statement of cash flow, obviously yes, and notes thereby. Analysts use various information in financial statement analysis beside annual financial statement. For example, MD&A, the disclosures and analysis, earnings announcement, external data, external sources, and direct experiences. Steps in financial data is to articulate the purpose and context, collect the data, process the data, analyze the data, develop and communicate your conclusion and recommendation, probably follow up. And with this, I come to an end of this video. Thank you for watching it.